Have you ever wondered how to set up a simple, balanced portfolio that pays you steady income while growing your wealth over time? In this video, I'll walk you through a step-by-step approach to building a core portfolio using dividend ETFs so you can invest with confidence, even if you're just starting out. Before we dive in, remember, this is not financial advice. Always do your own research and consider speaking to a professional before making investment decisions. Let's start with why this topic actually matters. A core portfolio is the foundation of your investing strategy. It's designed to be stable, reliable, and to help you weather market ups and downs. By using dividend ETFs, you combine the benefits of steady income with the potential for long-term growth. This means your money works for you, not just through price appreciation, but also through regular cash payments known as dividends. Many investors get overwhelmed by all the choices out there. Stocks, bonds, funds, it can get confusing fast. But building a core portfolio doesn't have to be complicated. By focusing on a handful of carefully chosen dividend ETFs, you can keep things simple and effective. So what exactly is a dividend ETF? Let's break it down. An ETF, or exchange-traded fund, is a basket of investments, often stocks or bonds, that trades on the stock market like a single share. A dividend ETF specifically holds companies that regularly pay dividends. These are cash payments companies make to share their profits with investors. Now let's get into the first key step, understanding what to look for in a dividend ETF. The three main things to consider are dividend yield, payout ratio, and diversification. Dividend yield is simply the annual dividend payment divided by the share price, expressed as a percentage. For example, if an ETF pays $2 per year in dividends and its share price is $40, the dividend yield is 5%. It tells you how much income you can expect to earn for every dollar you invest. But yield isn't everything. High yields can sometimes signal risk, like if a company is struggling and its share price has dropped. That's where the payout ratio comes in. The payout ratio shows what percentage of a company's earnings are being paid out as dividends. Lower ratios often mean the dividend is more sustainable. If the payout ratio is too high, say above 80%, the company might struggle to maintain that dividend if profits fall. The third key concept is diversification. This simply means spreading your investments across many companies, sectors, or even countries. Diversification helps reduce risk, so one bad stock doesn't sink your whole portfolio. ETFs make diversification easy, since each one holds dozens or even hundreds of companies. So, how do you use these ideas to build a balanced core portfolio? Let's look at three main sections you should consider: US, dividend ETFs, international dividend ETFs, and sector diversification. First, US dividend ETFs. These funds focus on American companies that have a strong history of paying and growing dividends. Examples include the Vanguard Dividend Appreciation ETF, with the ticker symbol VIG, and the Schwab US Dividend Equity ETF, ticker SCHD. VIG holds large established companies that have increased their dividends for at least 10 consecutive years. Think of companies like Microsoft, Johnson & Johnson, and Procter & Gamble. These are not the highest yielders, but they offer a great balance between income and long-term growth. SCHD is another popular choice. It emphasizes both yield and quality. SCHD typically has a higher dividend yield than VIG, and it focuses on companies with strong financial health and a consistent track record of paying dividends. So if you're looking for a core holding, consider starting with a US dividend ETF like VIG or SCHD. They offer automatic diversification across dozens of leading American companies and provide regular dividend income. Next, let's talk about international dividend ETFs. Many investors make the mistake of only investing in their home country, but adding international exposure can help your portfolio in the long run. Different countries' economies don't always move together, so investing globally can reduce your risk. A good example is the Vanguard International High Dividend Yield ETF, ticker VYMI. This ETF includes companies from Europe, Asia, and other regions, all chosen for their strong dividend payments. By owning an international dividend ETF, you get exposure to companies like Nestle, Samsung, and Royal Dutch Shell, names you might not get with a US-only fund. Another option is the iShares International Select Dividend ETF, ticker IDV. This fund also focuses on high-yielding stocks outside the US, offering income and global diversification. By combining a U.S. dividend ETF with an international dividend ETF, you spread your investments across many economies and industries, making your portfolio more resilient. The third element is sector diversification. Even within dividend ETFs, you want to avoid putting all your eggs in one basket. Some dividend funds may be heavily weighted toward industries like utilities or financials, since these sectors are known for paying higher dividends. But if something happens to that sector, say a new regulation hurts banks, your portfolio could take a hit. To check your diversification, look at the sector breakdown of your ETFs. Most fund providers list this information on their websites. Ideally, you want exposure to many sectors: technology, healthcare, consumer goods, utilities, and so on. For example, VIG has significant investments in industrials, healthcare, and consumer staples, while SCHD leans more toward financials and technology. By combining different dividend ETFs, or by choosing funds with broad sector representation, you help protect yourself from sector-specific risks. Now, let's talk about asset allocation. How much to put in each ETF? A simple starting point for a balanced core portfolio might look like this: 60% in a U.S. dividend ETF, 30% in an international dividend ETF, and 10% in a sector-specific or specialty dividend ETF, like one focused on real estate or utilities, if you want extra income and diversification. Of course, this is just an example. Your own allocation should reflect your goals, risk tolerance, and time horizon. If you're younger and have a long time to invest, you might lean more toward growth-oriented dividend ETFs. If you need more income right now, you might prefer funds with higher yields. Let's quickly revisit those key terms, just to make sure they're clear. Dividend yield is the percentage of your investment you can expect to receive as income each year. Higher isn't always better. Look for yields that are sustainable, not just flashy. Payout ratio is the portion of profits paid out as dividends. Lower payout ratios usually mean the dividend is safer and more likely to grow over time. Diversification means spreading your investments across different companies, sectors, and regions to reduce your risk. ETFs help you do this automatically. As you build your dividend ETF portfolio, keep things simple. Start with a broad U.S. dividend ETF, add international exposure, and make sure you're not too concentrated in any one sector. Revisit your portfolio every year or so to make sure it still fits your needs, especially as markets and your life circumstances change. Remember, investing is a journey. The goal isn't to get rich overnight, but to steadily grow your wealth while enjoying the peace of mind that comes from regular dividend income. If you found this video helpful, please consider liking and subscribing to the channel. Let me know in the comments what dividend ETFs you're interested in, or if you have questions about building your own core portfolio. Thanks for watching, and happy investing!